Hello and welcome back to the Note. It's that time of year again when we pay a visit to Hindsight Capital. For those who don't read the long view regularly, this is an exercise I've been doing for several years, and Hindsight Capital is an imaginary hedge fund which has the ability to see the future. Hindsight regularly beats all other strategies. Now, there are some limitations on it. It's not allowed to trade during the year, it's not allowed to juice things up with leverage, and it's not allowed to bet on single stocks. But critically, it is allowed to sell short, i.e. to profit from a prediction that a stock or a security is going to go down. Now, let's take a look at what Hindsight Capital did at the beginning of this year. First of all, it relocated to Indonesia. Why? Because it got money illusion on its side that way. The Indonesian rupiah was the worst performing major currency of the year, thanks to great worries about its current account deficit, and it dropped almost 20% against the dollar. That means that if you denominated anything in rupees, it automatically seemed much better. The S&P 500 is not up quite 30% for the year, but denominated in rupees, it's up 49.7%. Second, the second big trade that Hindsight would have made is to go long stocks, short treasury bonds, stocks through the S&P 500. This is, again, a very straightforward, optimistic trade. Bonds were plainly historically expensive after a 30-year bull market for bonds. If you believed that things were going to pan out well, this was an obvious trade to make, and it worked beautifully, making you 40.5% for the year. The next trade capitalizes on the vagaries of American politics. You could call it the anti-Tea Party trade, or the Tea Party pooper trade. First of all, you short the stocks of gold mining companies. Why do you do that? Because you could tell with concerns about inflation reducing and worries that the Fed was going to carry on printing money ad infinitum, also reducing, that there would be less demand for gold as a hedge against hyperinflation, and indeed the gold price fell. You would express that in a bet against gold miners because the gold mine companies, largely speaking, had borrowed excessively while gold was going up, in the belief that the gold price was going to stay where it was. As the gold price fell, so their stocks fell much more. The FTSE Gold Mines Index fell 54% for the year. Now you take that trade and you put the proceeds into the S&P 500 Healthcare Index. Why do you do that? Well, Obamacare is deeply unpopular and controversial in the US, and its implementation has been very badly botched in the last few months. But the bottom line is still that it's very likely to be implemented, that many more Americans will have health insurance, and so much more money will be spent on healthcare products. The S&P healthcare sector was up 34%. So the result of making this trade, betting against the predilections of the Tea Party, was a gain of 192%. As we'll hear later, there was still one fantastic way for people with the Tea Party beliefs to make a lot of money this year. Fourth trade goes to Japan. Long the Nikkei, the stock index there, short the yen. Abenomics was a huge development this year. It involved printing money in an attempt to stoke inflation in Japan. That had a fantastic effect on the stock market. It also weakened the yen, so you needed to bet against the yen while putting money into the stock market. Very easy to trade to do using ETFs, and it would have gained you 47.6% for the year. Next, we go to the Eurozone. Hindsight could see that a resumed crisis in the Eurozone wasn't going to happen, that the ECB's promise to do whatever it took to save the euro would keep confidence intact. If you're confident about that, then the best way to bet on it is to buy Greek government debt. It's the country that had suffered the most from fears of a euro breakup. Long Greek government debt gained 32% for the year. Now, the final trade I'd like to mention, we're not going to illustrate because it's literally off the charts. It concerns the Bitcoin phenomenon. For those who are uninitiated, this is an online currency using very advanced cryptography, which many of its adherents believe could become an alternative to fiat money. It could hold its value if central banks succeed in debasing other currencies around the world. Their enthusiasm for this has, it seems to me, got a little out of hand. If you had sold short gold at the beginning of the year, the gold price fell 26% during the year. Meanwhile, bitcoins, according to one exchange, have gained 66-fold, by a multiple of 66 over the year. Put those together, and if you had sold 1 ounce of gold at the beginning of the year and used it to buy bitcoins, those bitcoins would now be enough, if you sold them, to buy 90.6 ounces of gold. Might imply, I would suggest, that the Bitcoin bubble has gone a little far. I don't think you need hindsight to think that it would be a good idea to make that trade, to convert bitcoins back into gold now. Now, what are the main conclusions we can draw from this hindsight exercise? First of all, it's not a fair benchmark for a normal fund manager, because plainly most fund managers don't have perfect foresight. You have to protect yourself against the risk that you are wrong. However, it does show you that if you make your bets, if you make your positions in the right direction, there was a lot of money to be made this year. And this year, basically, you got a big reward for being optimistic. If you saw that we were going to avoid the many great risks that were on the horizon at the beginning of the year, and that particularly the US economy would pan out towards the better end of expectations, you could have made a very large amount of money this year. But unfortunately, I'm afraid to say, I don't know what Hindsight Capital's positions are for 2014 just yet.